Hello everyone. In the previous tutorial we looked at how to estimate expected return on standard deviation as well as the geometric mean on each of your securities. In this tutorial I'll show you how to estimate the volatility of volatility. Most of the financial textbooks, especially on the undergraduate level, they all assume that the standard deviation will be constant for your securities. However, as you will see in a few minutes, this is obviously not true, and the risk of securities does vary with time. So what we want to do is we want to calculate and see how the standard deviation changes over time, and in which particular periods the standard deviation is higher and in which periods that standard deviation is lower, and can we tie the increase in the risk of the security or the portfolio to any particular economic or financial market events. So for this purpose I will be using a technique called rolling estimates. So in order to estimate the standard deviation, to get a good estimate of standard deviation, or actually to get a good estimate of anything, we need some amount of data. Normally, to get an accurate measure of the standard deviation, anywhere from 2 to 4 months of daily data will be required to get the estimate or reliable estimate of the standard deviation. So what I'm going to do, I'm going to copy just this, and my first estimate of the standard deviation will only be possible after the 3 months of the data that I already have. So I'm going to start estimating my data beginning April 1st. That will leave me with, there's, sorry, April 1st here. So here are the stock names. These are obviously not the stock names, so I will have to point it to right direction. So that will be Akita. And for the next 4 stocks, dates will be here. Standard deviation on the index, I'm going to stick with my sample standard deviation, and that would be based on the data available today as well as the past 3 months that I've skipped. I'm going to go ahead and right away annualize the estimates of the standard deviation, 23%, and I can calculate this for all of my securities. What I'm going to do in addition to that is I'm going to construct a portfolio, and I can actually do it from here. This portfolio will be a naive, equally weighted portfolio based on the 5 securities that I already have in my sample. So I'm going to take 1 over 5 times the return on Akita plus 1 over 5 times the return on Algoma plus 1 over 5 times the return on Hydropeller plus 1 over 5 times the return on ATCO and 1 over 5 times the return on the BCE. I'm going to copy the reference down. So these are the returns on the portfolio, equally weighted portfolio comprised of these 5 stocks. And sorry, I forgot what my reference was. One additional thing here is going to be my portfolio, my equally weighted portfolio. I'm going to use the reference that I have here and apply it to my portfolio, which is here. This is the standard deviation. One thing that you have to notice is that if you look at the standard deviations, I can make it in the percentage term form if that's easier. This is my market standard deviation. These are my 5 securities, and this is the standard deviation of the portfolio comprised of these 5 securities. Notice that the risk of the portfolio comprised of 5 individual security is much lower than any of the individual riskiness of any particular security. So this effect you will normally observe in your portfolios as well, and it's called the diversification effect of the portfolio. Now I simply copy down the reference, and what happens that with a rolling estimate you can see that my reference is constantly changing and will always be based on today's data plus the last 3 months of observations. So this way, when you drag down your formula reference for the standard deviation, each new observation will contribute to the standard deviation estimation, and you will have a rolling estimate of standard deviation. You can plot it on a daily basis and see how your risk of your portfolio or security or the index varies across time. So if I select this range of data now, and we'll try to plot it by inserting the line plot. This line plot will contain the estimated standard deviations of your securities. One thing you can notice that each of the individual securities will have the higher standard deviation, and the bottom one, which is the equally weighted portfolio that I construct, it's a naive portfolio with equal weights, has actually most of the time the lowest standard deviation of any individual securities and even of the TSX index. Another thing that you can notice from this section is that during the 2008 global financial crisis, the standard deviation probably was one of the highest in all of the years that we've analyzed. For particular securities, you might have spikes in risk, maybe attributed to the firm-specific events. This is something that you can investigate and see why are the reasons that the standard deviation was particularly higher for Algoma Central Corporation in February 2013, for example. Why is it increased volatility or the riskiness on Algoma Steel again in 2011? So this analysis allows you to concentrate more and see and decide what events prompted that stock to be perceived as a more risky investment by the investors on the stock exchange.